The Federal Reserve is meeting soon. This meeting is important. The Fed will decide on interest rates. Interest rates affect everything from loans to savings. Right now, the economy is sending mixed signals. Inflation is cooling down, but the job market is slowing. The Fed has a tough choice to make. The Fed's main goal is to keep prices stable. They also want to support a strong job market. To control inflation, the Fed raises interest rates. This makes borrowing more expensive, which can slow down the economy. Lowering interest rates can boost the economy, but might lead to higher inflation. This meeting is getting a lot of attention. The Fed's decision will have a big impact on the economy. Businesses and investors are watching closely. Everyone wants to know what the Fed will do. The Fed is facing a difficult situation. The economy is sending mixed signals. On one hand, inflation is cooling. This is good news. It means prices are rising at a slower pace. On the other hand, the labor market is weakening. The unemployment rate is ticking up. This suggests that businesses may be hiring less. The Fed must weigh these factors carefully. They need to decide if slowing inflation is worth the risk of higher unemployment. The Fed's decision is further complicated by global uncertainty. The war in Ukraine and tensions with China are creating economic headwinds. These factors add to the complexity of the Fed's decision-making process. Within the Fed, there are different opinions. Some officials believe the Fed should cut interest rates now. They argue that inflation is under control. They worry that high interest rates could harm the economy. Other officials are more cautious. They believe the Fed should wait and see. They worry that cutting rates too soon could cause inflation to rise again. These differing views highlight the challenges facing the Fed. They must find a balance between supporting the economy and controlling inflation. The Fed's decision-making process is based on data and analysis. They consider a wide range of economic indicators. However, there is always an element of judgment involved. This is why the Fed's meetings are closely watched. The outcome can have a ripple effect throughout the economy. Section 4. Clues from the projections. The Fed will release its economic projections at this meeting. These projections offer clues about the Fed's thinking. Investors will be looking for any changes in the Fed's outlook. One important part of the projections is the dot plot. This chart shows where each Fed official expects interest rates to be in the coming years. Changes in the dot plot can signal a shift in the Fed's policy stance. The projections also include forecasts for inflation, unemployment, and economic growth. These forecasts provide insight into the Fed's assessment of the economy's health. Investors use this information to make decisions. Section 5. Decoding the Fed's message. After the meeting, the Fed will release a statement. This statement will explain the Fed's decision on interest rates. It will also provide clues about the Fed's future plans. Fed Chair Jerome Powell will hold a press conference after the meeting. Investors will be listening carefully to his words. Powell's comments can move markets. Investors will be looking for any hints about the future path of interest rates. The Fed's communication is complex. They use nuanced language to convey their message. Investors and analysts try to interpret every word. The Fed's goal is to provide clarity, but their statements can sometimes create confusion. Section 6. The stakes are high. The Fed's upcoming meeting is a major event. Their decisions have far-reaching consequences. The outcome of this meeting will impact businesses, consumers, and investors. If the Fed cuts interest rates, it could boost the economy. This could lead to higher stock prices and increased consumer spending. However, it could also lead to higher inflation. If the Fed keeps interest rates unchanged, it could signal that they are concerned about inflation. This could cause uncertainty in the markets. Businesses may postpone investments and consumers may hold back on spending. The Fed faces a delicate balancing act. They must weigh the risks and benefits of their actions. Their decisions will shape the economic landscape for months to come.